Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're going to start with the equity market today because we closed as of Friday basically in correction territory, the market being down about 10.5% off of its high, which was reached on July 27th, at least if you're following it via the S&P 500. So a correction is a 10% decline in prices during a longer-term bullish trend in market, which we've seen here. Although this is looking a bit shaky and we do have volatility at levels that indicate the market's under pressure. Whenever this VIX volatility index that's now displayed is above 20, and it is, that indicates that, market participants are under stress. And particularly the level it's at now, which is, we'll call that 21, indicates that market moves of approximately 1.3% plus or minus are the expectation for the next couple of weeks, the next month. So we're expecting daily moves, swings in the market of plus or minus 1.3%. And that's significant. 1.3% is about 50 some S&P points. So the markets are definitely more volatile. It is expected at this time of year. September and October traditionally have been the most volatile points of the year. And we'll see what happens as we enter November. Does that change? Do things start to firm up, and does the market psychology begin to improve? Earnings season has been coming in, and companies have been writing down their expectations. So that is potentially a factor. The geopolitical risks, the things that are going on, the war that erupted in the Middle East and appears to be intensifying. The ongoing war in Europe. There are a lot of factors that could be leading to a negative market psychology. We're going to come back to the S&P to close. Interest rate wise, this is an interesting scenario. This gold line shows basically a month ago what the yield curve was, and the green line shows where we're at now. And as you can see, at the longer end of the curve, you start getting out 7 years, 10 years, 15, 30, and so on. The rates have gone up pretty substantially while they've remained tethered at the short end of the curve. And this is important. So this picture really tells us a story. It says market participants view the Federal Reserve as being largely on hold for now. They're not going to be moving rates very far, but they're also prepared to accept a longer-term, higher inflation environment. And so market participants are adjusting to that by raising what they would require to earn for the interest rates for holding the risk-free asset over these longer time periods. So that is what's called the inflation risk premium, or the duration risk of a bond, and it's definitely increased in response to presumably inflation expectations. What's happening for corporate debt? That's also rising. That's rising just strictly as a function of the fact that corporate debt is priced off of the Treasury curve, plus it adds a default risk premium, which may be increasing as well because as these prevalent interest rates get higher and higher, some corporations become riskier, and therefore investors require more in terms of a yield in order to buy the bonds, in order to take the risk of owning the bonds. So that's not necessarily a bad thing, but we do think that some weaker credits may eventually come under pressure in this environment. And look, 5-year yield, this is great if you're an income investor. 5.6%. You go out 10 years, you're getting 6%. This is fantastic. We haven't seen rates like this in a very long time. So we're watching the yields. Yields are very good for corporate credit investors. The stock market, yes, is looking a bit shaky right now. In the longer term, that remains to be seen. Let's talk about a dynamic that we're starting to see, and this has us a bit concerned. This is credit card delinquencies as measured by the Federal Reserve across all banks, and this has been coming up pretty sharply on a quarterly basis since the end of 2021. Where at the end of 2021, this was about 1.55%. Now we're at 2.77. We're almost double. These are still historically very low levels of credit card delinquencies, but the fact that they're rising and the slope of that line indicates that there may be some struggling under the hood of this economy, perhaps in this era of free money that came about, in the 2020 crisis, and even before that for a long period of time. Maybe these cash reserves are starting to run out, and consumers may become tapped over time. So we're going to continue to watch this metric very carefully. But with that said, the economy is certainly not showing us any signs of weakness. Recently, we got reports on gross domestic product, which crushed expectations. We recently got labor market data that crushed expectations. We recently got real estate market data in terms of new and existing home sales that crushed expectations. So what's going on? Well, over the next couple of weeks, we're going to see if that persists. We get information about consumer confidence, and that's important because consumer spending, which is driven by consumer confidence, is about 2/3 of GDP growth. So a slowdown here could indicate that GDP growth is going to begin to slow down as well. We get the outlook in manufacturing, construction. We get the Federal Open Market Committee's rate decision, which is widely expected to be a zero. In other words, no rate hike, no rate cut. They're going to take a wait-and-see approach. We're also expecting that here. However, as opposed to what the interest rate markets in the futures are saying, which gives it a 0% probability, we're saying probably more like 10 to 20% chance that they may hike rates because of all of the strong numbers that have been coming in. And those strong numbers indicate two things. One, the economy is still growing at a much more rapid clip than what they're comfortable with at the Fed in order to control inflation. And two, that the economy can handle another rate cut should they decide they need to go there. So we think that while the futures markets are saying, hey, there's a 0% chance, potentially it's not zero. That said, that is still the expectation, and that's our expectation when this number comes out Wednesday. We'll get labor market information again. We'll get more sentiment information. Next week, really key, consumer prices will come out. That indicates whether consumer prices are starting to slow down in their advance. If they are not, that's an inflationary indicator that says the Fed still has more work to do. The following day, we get producer prices. And what's more important in either of these cases than the individual number is what their interplay says. Because as equity investors over the longer term, at least in the stock portion of our portfolio, we want to see what's happening with corporate margins. Are margins declining or are margins increasing? That being your sales minus your costs. So if the producer costs are going up faster than consumer costs are, that signals that pricing is limited, or pricing power is limited, and producers are making less dollars per unit sold than they were before. And that's actually not a good argument for higher stock prices. That's an argument that stock prices maybe will come down. So we're watching that pretty carefully as a determinant of figuring whether this downturn, this correction that we're in, could potentially turn into a more significant bearish trend in equity prices over the longer term. With that said, that's not our expectation. We are expecting to see these slow down a bit. We'll get labor market and housing market information to round out the week. So with all of that said, the picture has been very strong, although we're seeing some weakness under the hood with the credit card delinquencies. We're seeing certainly chop in the market and volatility in the market. But does that really scare us into worrying about getting out of stocks? Absolutely not. Taking the longer term view, an investor in stocks over the last 20-year period, even with the current drawdown into equity prices, is still earning, north of 7%. And that's at a period when we're in drawdown in the equity markets. If we took that same thing up to the highs, we get closer to 11% annualized returns. So, taking a short-term view and using that to change a long-term plan that's designed to deliver results over many years to achieve financial goals just doesn't make sense. If you've got questions about your portfolio, if you've got questions about your investment strategy or the economy or anything else, feel free to reach out to us. We love to talk to you. Hope you found this video useful. Have a great day.